Hi everyone, it's Sabrina at Fox Legal Training. I wanted to discuss what the implications would be of the sale of McLaren's automotive business, given the recent announcement that this would take place with some new investment. I'm going to share my screen and just show you the announcement that I am looking at for this purpose and what it is that is important or significant to me. So there's a non-binding agreement, and then the prospective deal has new capital investment coming through. And then it is specifically in respect of the automotive business with a non-controlling stake in McLaren Group also on the auction block. So what I'm going to do now is share the actual offering memorandum of McLaren itself and take you step by step through how I am thinking about this. So given that we have seen that the entities themselves, obviously we'd want to check that the new entity is a new entity, that it's not already a permitted holder. But the other thing we want to look at is where in the corporate structure is that entity actually at? Is it up here, in which case you're more likely to be thinking through things like change of control, or is it down here when you're thinking through topics like asset sale covenant, but also potentially change of control under the sale of all or substantially all assets prom? So here we can see McLaren Automotive Limited, which is the entity which is implicated by the announcement, is sitting in this line here, which means it's not all of the business and is not a change of control from the purposes of the beneficial ownership prong. And that doesn't mean that it isn't a change of control in respect of the sale of all or substantially all assets prong, and we will get to that in just one second. But before we do, I want to look at the asset disposition definition, because what that is going to tell us whether this asset is carved out from the definition of asset disposition, because if it is, then it isn't subject to the asset sales covenant at all. So I have looked at this. I do not see anything that suggests that this entity is carved out from the definition. So for that reason, we don't need to spend any more time on that aspect of the analysis, and we can go straight to the asset sales covenant, which is going to tell you what the requirements are in respect of the sale of this asset. So the borrower needs to get not less than fair market value, 75% cash and cash equivalents. And there's some other aspects of cash and cash equivalents here. This is different features that can be. And then it will go down here in this paragraph and talk about how proceeds need to be applied in repayment of debt or investment in replacement assets or acquisition of a similar business, CapEx, acquiring other assets, any combination of the foregoing. And then it goes through the excess proceeds offer provisions in the case that there are excess proceeds, which is defined as anything in excess of 20 million after the proceeds have been applied. So you would go through this analysis if you wanted to think through, could the borrower repay other debt ahead of the note holders? Are there provisions that would require the borrower to repay all debt pro rata? Can the borrower use proceeds for restricted payments or permitted investments, which is not a flexibility that I see here? So those are the kinds of things that you're going to be looking through. And then when you're looking at the change of control definition, what you're really thinking about here is the sale of all or substantially all assets trigger, which is here. Now, substantially all assets is a term of art. Under New York law, it has been adjudicated, but not very much. So there isn't a huge amount of case law to give us a sense of what this actually means. But what you're thinking about are sales of assets which would manifest a significant change to the nature of the business of the borrower. So from the perspective of the lender, is this going to change the borrower's business so much that actually from the change of control perspective, we want to give them another opportunity to revisit their investment decision, which is effectively the protection that change of control gives you. And then if you revisit the investment decision and you decide you don't want to be part of this credit anymore, you put the bonds back to the borrower at 101. Now, it's typically considered as proportion of assets, revenue, EBITDA of the borrower, and that would need to be something in the region of 2/3 or more. Sometimes 75% has been stated. So it's a high percentage of the assets, but also it can also be if it's the assets like the crown jewel of the borrower. So the thing that makes it who it is, even if it's not necessarily a majority or more or super majority of the assets, a significant proportion of the assets, assets, it can be that it's so important to the functioning of the borrower that it is just the borrower wouldn't be the same business without it. So those are just some general guidelines to think through when you're considering all or substantially all. But from my perspective, consider as well that the borrower themselves would have done an analysis with their counsel about whether they believed that this transaction constituted a sale of all or substantially all. And non-controlling stake and other kinds of words in the announcement to me suggest they don't believe it is. And often what you'll see is when there's an announcement like that, sometimes the borrower will make their own announcement and will say, we do not believe this constitutes a change of control. We do not expect to make a change of control offer. Or sometimes borrowers will belt and braces the whole analysis and do a consent solicitation to waive any potential change of control. Even if they don't believe that it's a change of control, they just want to reassure the transaction goes through smoothly, and from that perspective, pay maybe 25 basis points or some small consent fee to the lenders just to ensure that there are no issues. So this is obviously all still in process. This is a proposal. It's non-binding. They are considering, they're exploring, etc. So we'll see how things unfold, but I wanted to give you some sense of how to conduct that analysis when a borrower is selling an asset to a third party. Think through the permitted holders definition. Is the third party already a permitted holder or an affiliate of the permitted holder? Think through whether the asset itself falls within the definition of asset disposition, because if it doesn't, the asset sales covenant is not relevant. And then once you've done those threshold inquiries, you want to think through the requirements of the asset sales covenant and then the triggers for the change of control covenant. Bearing in mind that sale of all or substantially all assets prong is a facts and circumstances analysis. So it isn't something you can really pin down. You have to think through all of the context behind what the asset means in the broader business context of the borrower. I hope that has been helpful. If you have any questions, do feel free to get in touch. I will do some updates if we see this continue to unfold, if more announcements come out in the coming days and weeks. But in the meantime, wishing you all a wonderful day and week, and feel free to check out our online covenant education platform where you can find courses that will teach you how to do this analysis for yourself. Whenever something comes across your desk, you'll be fully equipped to conduct the covenant analysis. And that's all available for you at www.foxlegaltraining.com. Takes care, everyone. See you next time.